In this short video we're going to look at company shares. So by the end of it we'll have said what we mean by a share's nominal value and how we calculate a company's share capital. We'll go on to discuss what is meant by a share premium account and how that's calculated. Lastly, we'll then look at preference shares and how we calculate the dividend payable to a preference shareholder. So we'll start by talking about ordinary shares. Well, a private company limited by shares or a PLC will have ordinary shares. These are issued right at the start of the business when it's created or incorporated, but they can also be issued at a later point as well if the company, for instance, needs to raise money for a new project. So ordinary shares fulfill two valuable purposes. First of all, they raise money for the business, and secondly, they give the owners of the business their share in the profits of the business. So a share represents the partial ownership of the company. So for example, a company has, say, 1,000 ordinary shares in issue, and Dave owns 650 shares, with Cassandra owning the balance of 350 shares. As a result of that, Dave owns 65% of the company. That's 650 divided by the total ordinary share capital of 1,000, and Cassandra owns 35%. So when the company pays dividends to its shareholders, 65% of those dividends will go to Dave and only 35% to Cassandra. Now, when we're talking about shares, they all have what's called a nominal or face value. Now, that can be of any particular value. The most common one would be £1, but it could be 1 penny, or it could be a fraction of a penny, or any amount that the company deems fit to use. The company can issue shares to new shareholders at that nominal value, or it can issue them at above the nominal value, but they're not allowed to issue them at below nominal value. When we talk about ordinary shares, or indeed any particular shares, a company can have more than one class or type of share. So for instance, a business might have ordinary A shares, ordinary B shares, ordinary C shares, etc. Now each different class of shares will have different rights attached to them, and when I talk about rights, I'm talking about things such as voting rights at shareholders meetings. Many businesses, for instance, have their normal ordinary shares and might have a separate class of ordinary shares that are non-voting, so somebody owning those shares would not be allowed to vote on any resolutions at a company, at a general meeting of the company. We'll now look at how we calculate share capital in a business. This is actually very straightforward. What we do is we multiply, first of all, the number of shares that we have in issue, so the number held by all of the different shareholders, and we multiply that by the nominal value of the shares. So let's have a look at an example just to illustrate how straightforward. So let's say that a company has 100 ordinary A shares of £1 each and 1,000 ordinary B shares of £5 each. Well, we would calculate the share capital as follows. So we have 100 ordinary A shares with a nominal value of £1. So the total share capital of ordinary A shares is £100. We have 1,000 ordinary B shares, each has a nominal value of £5, so overall the share capital of ordinary B shares is £5,000, and to calculate the company's total share capital we simply add those two together to give us 5,100. Now, as you might have noticed, a company can issue shares at above the nominal value of those shares, but it can't do it below that. Now, when this happens, the company's share capital is going to be increased in the same way that we've just been through. So we would calculate the number of shares issued and multiply that by the nominal value of those shares. But if we've issued those shares at a price higher than the nominal value, the additional money over and above that has to go somewhere, and it's actually recorded as a share premium account, and that share premium account is included in the company's equity. So let's just illustrate this. Let's say that a company has 1,000 ordinary shares of £1 in issue, and it decides to raise additional funds by issuing 500 ordinary shares of £1 each, and those are going to be issued at a price of £40 each, either to the existing shareholders or to new shareholders. So the share capital, well, it will start off before the share issue at £1,000. That's the 1,000 ordinary shares multiplied by the nominal value of £1 each. Then we've got to calculate the additional share capital raised by this new share issue. Well, that is 500 shares multiplied by the nominal value of £1 each. So that works out at £500. So our new share capital after this share issue increases to £1,500. But of course the amount that we actually received from that issue of £500 is 500 shares multiplied by £40 each. That's £20,000. So the balance of that £20,000 is going to go to our share premium account. So we'll work that out. The funds that were raised, as I said, were £20,000. Of that £20,000, 500 has gone to increase the company's share capital. So the difference of £19,500 will go to a share premium account and be included in the equity section of this company's statement of financial position. Lastly, we're going to talk about preference shares. Now, not all shares issued by companies have to be ordinary shares. Preference shares are different to ordinary shares in that they don't give the holder of the preference share the same interest in the company's profitability. Instead, preference shares commonly receive a dividend each year from the company that's based on a fixed percentage of the share's nominal value. Now, the reason why they're still attractive to investors is that dividends on preference shares are paid before a company can pay dividends to ordinary shareholders. Although it is the case that a company can still elect not to pay any dividends at all, but if it is going to pay them, they have to pay their preference shares first. Now, what this means is that owning preference shares is less risky than owning ordinary shares, and that's why they can be attractive to investors. Also, if the company is wound up, preference shares are paid out before ordinary shareholders. So there we can see that these type of shareholders are preferred, and hence the name. So let's have a look at how we calculate the dividend payable to a preference share. Let's say that an individual owns 800 12% preference shares of £1 each. Now, every year that individual should receive dividends from these shares of 12% of the nominal value. So that's 12 pence per share. Now, this individual has got 800 shares, so it's going to be 800 multiplied by 12 pence per share, or 96 pounds. So we can see there that calculating the dividends payable on a preference share is very straightforward. And that brings us to the end of this short video on company shares.